Well, hello again, everyone, and welcome out to your Maverick Trading presentations. This is an earnings and volatility class. Corey Halliday here with you. I'm excited about the opportunity to go through this. We've had a request for a little bit more in-depth study of implied volatility and how it works around earnings and so forth. And so we put this class together with that in mind. We're going to talk about what the stock normally does around earnings, what volatility or implied volatility typically does, and hopefully build a much better understanding of these principles. So without any further ado, we're going to jump in here. We're going to talk about some live examples, but of course, make sure that you always fall back on your trading plan before actually acting upon any trades or setups or opportunities that way. Now, implied volatility. Let's talk a little bit about what implied volatility is, how it's calculated, just kind of build an understanding of it. I'm going to give some examples of it. If you've been in my classes before, you'll know I'll kind of jump around. I'll go live to the markets and I'll show some slides, and I'll even use some stick figures today, but we'll make sure that you fully understand what this is. Implied volatility is how much is priced into the option in terms of forward-looking expectations for volatility. So if we think about it logically, there could be two options that are identical in almost every way. You could have two stocks, hypothetically, that are both trading at $50 per share, right? They're both at 50. And they both have an August expiration, and that expiration is the same day. And so they both have the same call and put strike prices. They'd have a 50 strike call and a 55 strike call and so forth. So my question is, if the stocks are trading at the exact same price, they have the exact same amount of time to expiration, the exact same strike prices, etc., should the options be priced the same? And the answer, of course, is no, they probably won't be, because there's one factor that's different. There's one element. All the rest of it could be identical. But two stocks are not the same because they have different amounts of perceived risk. And that's what implied volatility is. It's once you strip away how many days there are to expiration and how far the stock price is away from the strike price and so forth, all those other factors that can be the same across all these different companies and all these different stocks, the reality is each company has its own implied volatility. Now, it is true that two companies could have the same amount of implied volatility, but normally they're going to be a little bit different. Now, if we think about this, again, this is how much the market is requiring. So if we think about it from a market maker's perspective, in the options market, you have bid and ask prices. Well, the market maker, his job is to set a bid and an ask, what he's willing to buy at, what he's willing to sell at, right? Bid on one side, the offer or the asking price on the other. And he can set both of those. Now, hopefully, we're trading liquid enough assets that other people are trading, and most of our trades are not going to the market maker. If we're trading a really active name, then there's all sorts of people bidding and selling these options, and so we're trading with them and so forth. But the market maker is going to set a bid-ask price. He's going to have an assessment for what this option should be priced at, and his prices are going to be dictated in large part due to supply and demand and so forth. But basically, he's going to kind of set prices, and it's kind of like an auction process where an auctioneer might have a pretty good understanding of what something should sell for, right? This should sell for around $40 or $50, hypothetically, right? That ballpark area. But the reality is the market can move it. So if people are really bidding it up, it could sell for above 50. Or if it's a really soft buyer's market and people aren't bidding, it could be trading below 40. The market maker is not going to force the price to be at any specific price, but he is going to basically make sure that the price is in a ballpark area. He's going to say, well, it's way too low if it should be selling at 40 or 50, and instead it's, they're only bidding it up to 10. That's way too low. You got to go better than that. If it goes to 80, he's very surprised and whatnot. So you can kind of think of the market maker as he's going to know the realistic expectations, and that's based off of the perceived volatility, how much volatility to expect. That's what implied volatility is. So what's the best indication of future volatility? Well, probably past, right? Past volatility is some indication of future. We have the history of what this stock normally does, how much it normally moves, and so the options are going to probably most of the time be pretty similar. They're going to say, you know what, this stock normally moves like this, so this is the appropriate pricing for the options. In a one-sided market, market makers are charged with the obligation to sell options to buyers in order to maintain liquidity, or vice versa. Market makers can be forced to sell or to buy, depending on the market, the orders that are coming in. Market makers can increase value of options by increasing their assessment of implied volatility. In other words, if there's aggressive buying happening, the market maker is going to say, okay, I'll demand a higher price and a higher price to keep selling more options. If the market's selling off, the options are falling in value, the market maker is being forced to buy, well, he might reduce his prices. He might say, I want to buy, I'll keep buying, but I'm going to reduce those down. So the option price is going to move back and forth based on market movements, market factors, supply and demand, and so forth. Now, I'm going to jump out of this, and I want to go live for a minute. And I drew up a scenario here that I thought would explain how implied volatility works a little bit better. And I wanted to use a real-life example of something that you see on a day-to-day basis that makes sense, and then we'll apply that to the options market. So let's say that we were in the business of selling car insurance. Now, did you know that when you do car insurance, there's an implied volatility associated with you? Okay, if I look at the class today, we've got Tim and Stan and Scott and Rick and Lindsay's on here, and Eric and Dwayne and so on and so forth. I'm not going to name everyone, but anyway, all of us have a perceived risk to us. If a 45-year-old male goes in looking for car insurance and he's never been in an accident and he has driven since he's 16 years old, what do you think the perceived risk is? Does he have a history? Does he have a background? And then also they'll do comparables. They'll say, who does he compare to, right? If he didn't have a track record, if he didn't have history. But in this case, they're going to say, you know what? The premiums, the implied volatility is very low. His risk to us is very low. He's proven to be very good and very safe. So the amount that the insurance company is going to charge to insure him is X amount, but it's a pretty small amount when compared to, you take your 16-year-old son in there, he's driving for the first time, and in this case, he doesn't have a history, but he has comparables, right? You can put him in a category and say, you know what, these 16-year-old males, they're crazy. They have a bad track record. We're going to charge a huge premium. Yeah, we'll insure you, but your implied volatility is very, very high. So the difference is how much it costs to buy insurance, right? The premium paid. That's exactly what we're talking about with options. Options, the best way to explain them is insurance. Because when you buy a put option, you can buy it to protect a stock. In fact, options were created with the purpose of being an insurance contract, to be able to generate income and to be able to insure stocks and portfolios and so forth. So if you wanted, let's just substitute things. Let's say that instead of this being a 45-year-old male, maybe this is, let's say it's General Electric. Okay? General Electric. This 16-year-old male, instead of being that, well, couldn't it be Tesla or, Nvidia or something more volatile? All we've done is said, okay, now it's not a person, now it's a company. But don't they have different levels of risk? Don't you feel a certain way about General Electric or Apple or Google or one of these big, huge corporations, multi-billion-dollar corporations with, relatively low day-to-day volatility? Their businesses are pretty much, you kind of know what you're going to get. Yeah, there will be little surprises here and there, but for the most part, you kind of know what to expect. And then there are more volatile names. There are newer companies. There are small cap businesses. There are companies without a long track record. They've only been in the market for 2 years and so forth. It doesn't mean that their stock price is going to go down. It means that the fluctuations of the stock, the volatility of the stock, is going to be higher. That's the market's expectations. So you can think of it as the premiums, how much an option is going to cost, is a direct reflection. That's what implied volatility is. So GE might have implied volatility of 10% or whatever, and Tesla might have implied volatility of 30%. And something really crazy and volatile might have implied volatility of 80%. So what does this number mean? These percentages that you get in implied volatility? Well, one way to think of it is as an annualized number. General Electric at a 10% implied volatility would be expected. Let's just say it's not trading at $100 per share, but let's say it was trading at 100. Its expected volatility range for the year would be between $110 and $90 with a 10% implied volatility. If Tesla were trading at $100 per share and it had a 30% implied volatility, then its volatility band or range would be expected to be between $130 and $70 per share. And what about this other stock, XYZ, that has crazy 80% volatility? Well, guess what? Its expected range is anywhere between $180 to $20, essentially. 80% implied volatility means that stock is going to move a lot over the next year. Can you find stocks that have 200% implied volatilities or higher? Yeah, you can, actually. If a biotech company, let's say that there's some small biotech that is going before the Food and Drug Administration, going to try to get approval for drugs or whatever it is, right? And it's got this one drug and its future is basically linked to this. Well, that could be make or break moment for the company. That stock price could go up 300% on this announcement, or it could go to zero in the blink of an eye. That's reality, right? And so you kind of think of it in terms of implied volatility. It's the amount of risk. And in the options market, somebody's always willing to buy or sell an option. The market will always basically have a buyer and seller if there's value. If an option's way out of the money, nobody's going to buy it if it's set to expire tomorrow. But my point is, if there's some real value, meaning the stock price is going to move, they'll set a price. They just might not set the price you want. They might set it too high, they might set it too low, and that's kind of what we're talking about is, as traders, we have to decide, are these reasonably priced and so forth. Now, let me take it to a real-life example. Now we've kind of shared what that's like in terms of options. You can see where I got my stick figure pictures here this morning. I thought hopefully that was a good way of explaining it. If it's not, then well, sorry. So here's the Nasdaq calendar. We can come in and look at what companies are reporting earnings this week. This is for July 18th. Some of these already reported, so let's go to tomorrow, hypothetically, and we'll say, okay, what's reporting tomorrow? Well, American Express is. Okay, and if we keep looking at the list, I'm just at the Nasdaq Earnings Calendar. This is a free website that any of you can go to. Actually, on Thursday, I know there's a couple, but we'll look at a few of these. American Express on Wednesday. On Thursday, July 20th, if we come down here, we can see a few names that are reporting. I was going to look for a couple that kind of stand out. eBay is reporting, and there it is, Microsoft. I thought Google was too. Maybe I already went past it. But anyway, there's a few of these names reporting this week. Union Pacific, big railroad company, and so forth. They're going to report earnings. Well, does that have an impact on how much volatility is being priced into the options? It does, and I'm going to explain that process. But if we look at these in any of your option chains and whatnot, we can get information, we can get data. So let's put them in categories. And let's say we have American Express, and we have Microsoft, and we have eBay, and we have, oh, that's probably good enough. Now, these aren't way different companies, but they all have their own set amount of implied volatility, of implied risk. So if I click on the option trader button, I can pull up the options, and in this case, it's for American Express. And for American Express, the implied volatility right now is at 18.8%. Let me change my color here so you can see it better. Right here, 18.8%. Well, how does that compare? A higher number means it's expected to be more volatile. The lower the percentage number, remember, if American Express were trading at $100 per share, that would give it a volatility band of about 118 to down to 82. It's about 18%, right? So let's go to Microsoft. I'll bet Microsoft's number is going to be lower. That's my prediction. I don't know that for sure, but actually it's a little higher. There you go. Just barely. 22% implied volatility for Microsoft. Now, I would have expected eBay to be the highest of them all. Well, let's see if that's actually the case. I guess American Express is it's massive and pretty slow moving, but sure enough, eBay is the most volatile. See, at 33% implied volatility. So it's telling you from the standpoint of risk, American Express is expected to be the least risky. Well, it's a huge financial company. The other two are tech names. Tech historically is a little bit more volatile. But eBay clearly expected to be more volatile than Microsoft. And that makes sense. I mean, eBay, maybe not as well established, not the huge corporation, not as transparent, and so forth. So that's the market's expectations. Now, you might disagree. You might say, you know what? I think this one's going to be more volatile than that one, and so forth. We'll look at some factors, some ways to look at this a little bit further, but that's the first step. This is the insurance company setting prices, and they're saying eBay's a little bit more like a 16-year-old driver, and Microsoft's a little bit more like a 45-year-old driver with no accidents, right? Less risk expected to be in Microsoft than in eBay. Less volatility or less in terms of fluctuations. Now, as we look at this a little bit further, we can see that all of these stock prices are different, but it all works on percentages. And you can see today that even today, American Express, very low volatility, very small percentage change move. Microsoft and eBay moving a little bit more. There's a little bit more volatility in them for today, just in terms of the movement. Now, as we jump back over, I want to talk about 3 things to expect around earnings. These are the normal behaviors. This does not mean that this is always the way it's going to work. These are the expected behaviors. So number 1, expect more stock volatility than on a normal day. When a company reports earnings, if you look at something like an ATR, let's say that a stock's ATR is $1. That means that right now it's averaging $1 of share movement per day. The low is $43, the high is 44, around that area. Doesn't mean it moves exactly $1 a day. That's just its average. Well, if you were betting and a company were reporting earnings, would you expect the volatility to be greater than its normal ATR? And hopefully everyone's saying yes. I would expect the stock on its earnings announcement to move more than normal. So if the ATR is at $1, I'm going to expect $2 or $3 of movement. It's going to move more than it usually does. That's expected, right? There's also volatility pre-earnings and post-earnings. And those have a tendency, this is the normal behavior, to do something as earnings approach and then as earnings leave. Let's talk about these behaviors. First, earnings and stock volatility. So earnings season is considered to be the first month of the new quarter. So right now, we're teaching this class in July. It's early July. We are in earnings season. So as we go through that calendar, we could have found, Amazon, Google, Apple, all the big names are going to be reporting right now because we're in the first month of the new quarter, right? January, April, July, and October is earnings season. You'll still get some companies that report on off months. You'll get some companies that report in December, but it's not very many of them. It's not the biggest names. It's not the market movers. So first of all, that's when earnings season is. Secondly, earnings are important because a company doesn't really update any of the numbers until earnings, unless there's going to be something materially different than what they were expecting. They could come out with a mid-quarter report that says, hey, we're going to miss badly. This is not going well, and they have to kind of give a pre-announcement. And that's a surprise to the markets and the stock. If it's a bad miss that's expected and surprising people, that stock's going to get killed. But for the most part, a company waits. It will report its earnings once every 3 months on this earnings announcement. So this is their chance to kind of give a State of the Union. Here's what we're doing. Here's how much we earned. Here's how much our growth numbers are. Here's where our revenues came in. Are we meeting our goals? What are our expectations for the future, et cetera, et cetera. If you're a fundamental investor, this is your opportunity to really value the business and say, do I think they're doing what I expected? Do I think there's any major changes? I would say that I think, as a general rule, people overreact to earnings in that, companies are going to have, just because a company doesn't, I think it's just pretty stupid, let's just say that people go and rush to sell because a company got 1 cent less earnings per share than was expected. That's just kind of dumb. Now, if you think that the growth going forward is materially lower than what you were expecting and it's going to be that way and some major shifts and changes have taken place and so forth, well, that would be different. But for the most part, the bark is bigger than the bite. People are expecting something to be, much bigger and much more aggressive and much more volatile than what it actually is. So the bark bigger than the bite, meaning usually a stock price doesn't move as dramatically as people fear that it might. So we get this expectation going in. When a company reports earnings, like we talked about, the stock will usually move more than normal, but it's already being priced in. Usually, implied volatility is ramping up before the earnings announcement takes place. So if a company were reporting earnings, let's say in July 20th, the implied volatility for the few weeks ahead of that will usually be increasing. Now, this isn't always the case, but as a general rule, as the earnings date approaches, people get more and more nervous. And as they get more and more nervous, they're willing to pay more for the options. Part of it is the fact that, especially with the public is, I'm going to call it the retail investor. a lot of times they're not worried about anything until it's basically smacking them in the face. So they're not worried about the earnings that are coming out in 3 weeks. They're not even thinking about that. They're not ahead of the curve. They're behind it, right? So they kind of get surprised. Oh, earnings are going to be out this week. Oh, they're coming out in 2 days. Well, I better get a trade on ahead of that. I better do something, right? And so it's kind of a situation where, for the most part, people don't worry about it until it's right there in front of them. But as it starts to approach, then they start to make their bets. Then they start to say, well, I got to buy some options. This stock's going to go crazy and so forth. And that tends to mark up the prices. If you think about it from a market maker perspective, he kind of knows this. So he's going to charge more. He's going to elevate. He's going to let the price of options go up because people tend to want to buy options into earnings. They think, well, I could strike it rich if this stock moves dramatically and I own these calls or these puts, then I'm going to make a killing, right? So as a general rule, the uncertainty gets people really nervous. The uncertainty causes the option prices to increase. Implied volatility of the options tends to increase pre-earnings. What does it do once the earnings come out? Well, normally you get a volatility crush situation. Not always, but usually that's the case, which means there's all this anticipation. And then the announcement comes out and they give their report, the decision's made. And what happens to the implied volatility? It collapses. So if you look at the implied volatility chart here, here's the historical volatility in blue. Here's the implied volatility in kind of a gold color. And after an announcement, it falls. And then it tends to ramp back up, and then the announcement comes out and it falls. And it tends to ramp back up, and then it falls. And it kind of moves basically where it declines after the actual announcement of the earnings. In a volatility crush, basically there was an expectation for a big stock move. It was priced into the options, maybe overpriced. Following the news, the event comes out, and the uncertainty premium is basically gone. I call it the unknown becomes known. So in the markets, there are known unknowns. You know the event is coming out. That's known. I know they're going to report earnings on July 20th. But the unknown is, I don't know what they're going to report. I don't know how the stock's going to move exactly. That's an unknown, right? Well, I said that the bark is usually louder than the bite. Well, that's what we're talking about here. The actual announcement comes out and everyone goes, no, that's not great. It's not bad. It is what it is. And the stock moves some normally, moves a little more than usual, but they were expecting some big event. The options were priced expecting some major move, and when that doesn't happen, the option prices get crushed. And so you can really get stung by this if you were expecting, let's say you buy call options on a stock going into earnings. Now you think, I need the stock to go up. I'm going to make a killing if it does. The stock is trading at $50 a share. You buy the calls, but those calls are really expensive because everyone knows earnings are about to be reported. The implied volatility is elevated, and you're paying a premium, a high price for that. The news comes out, and it's decent, and the stock goes up, and it goes from $50 to $51 per share. But your calls that cost you $4 collapse down to $2 in value. And you say, well, wait a second. That stock went from 50 to 51. It made a bullish move. Why am I not profitable in my call options? And the answer is the risk premium just collapsed. Implied volatility got crushed because they realized, you know what, this stock's not going to move that much. It was not a major announcement. It was not a game changer. All of that implied volatility collapsed back down to where it should be. So it went from 60% implied volatility all the way back to 15%. And that option that was priced at $4, it's now trading at 2. It just doesn't have the uncertainty around it. If you're in that situation, you can actually be right about which direction it moves, but still lose money if you get that implied volatility crush against you. The flip side of that is, of course, you could be on the right side of that trade. You could have put on a trade that was more neutral. And when that implied volatility crushed, you made all that money. You said, you know what? I think they're expecting too much volatility being anticipated. I'm going to take advantage. And sure enough, if you get the volatility crush, you're going to clean up. A volatility crush could occur also if there was a huge plunge in the VIX. The VIX is a measure of what the market implied volatility is, the S&P 500. Well, your stock is probably part of the S&P 500. If the entire market, basically, volatility gets crushed, if the volatility drops, then what is that telling you? Well, it's telling you that people expect less movement in stocks, less risk is being priced into the market, and since you're part of the market, your premiums are probably dropping as well. So this would usually only happen if there's macro developments, but the flip side of that is, of course, implied volatility can surge. If something major happens in the market, let's say there was a geopolitical risk or some sort of change in policy, political change where something of a shock hit the markets, volatility could ramp sharply higher. And since you're part of that, the premiums probably go up on all the options, and you can make money owning those options. So the point is, you can be on either side of this. You can profit from implied volatility going up or going down. You could also be on the wrong side. Risk of a broader VIX downturn is one reason why option buyers should be wary of situations where implied is running higher than historical, since an unexpected volatility crush can happen. So there's two numbers that you can look at in any situation. You can look at the historical volatility and the implied volatility. So I pulled Amazon. Now, Amazon reports earnings on June 26th. The historical volatility is at 27%. The implied volatility for Amazon was at 26%. In this case, the implied is a little less than the historical. In other words, the markets right now are pricing this stock to move about identical to what it has typically moved, right? And a little bit less, actually. They're expecting a little lower implied volatility. Let me jump back live to the markets. And again, we can look at some live examples here. Where was my chain? All right. Let's look at eBay. Let's go back into eBay. We know it had the highest implied volatility. Well, notice the difference. Historical volatility, 22%. Implied volatility, 33%. So are they expecting more volatility? Yes. This is implied volatility is future expectation. Historical is what it's done in the past. So historically, 22% volatility, implied at 33%. What does that mean to you? Well, it doesn't mean that it's mispriced. The market might have it exactly right. In fact, the market might even be underpricing it. But here's what we do know. We do know that they're pricing it right now at a higher level than what it has historically traded at. So they're saying it's going to move more than normal. So what would happen if the stock moved normal? What would happen if the stock moved the usual amount? If it moved 22% instead of the 33% that it's priced at? Well, you'd get a volatility crush. You'd get a situation where, again, that implied volatility is priced one way. If it moves the 22, you'd make money being short options, but you'd lose if you bought them. So this is if it, in this scenario, if the stock moves more to its normal 22%, the option seller would do well having collected at 33. The option buyer would lose having paid 33 and only getting 22% volatility. Hope that makes sense. So if your expectations are that the implied volatility is too high, what do? If it's too high, you want to sell volatility. You want to put on a strategy that takes advantage of volatility dropping. What if your strategy says it's too low? This number's too low and it's going to be more volatile than that. What do? You want to be an option buyer. You want to buy volatility to profit from the fact that it's going to move more than what the market is pricing in and expecting. So let's talk a little bit about strategy around these earnings plays. And, it doesn't even have to be around earnings. It could be around anything. What would be examples of buying? Well, simple examples. If I think this is too low and I want to buy volatility, I could come in here and I could buy a call. So let's say we went to August 4th. If I'm bullish and I think the implied's too low, I could buy a call option. Okay, I buy the 35 strike call. If I'm bearish and I want to profit from implied volatility, I could buy a put, right? Something like that. That's an obvious answer. More specific, more common would be buying a straddle. In a straddle trade, you buy a straddle or a strangle. You buy both a call and a put. So if we were doing a straddle, we might buy the 36 strike calls and buy the 36 strike puts. Why would you buy both of them? Because you're expecting volatility. You're expecting a move larger than what the options market is priced in. If you don't know the direction, that's one way to take advantage of a bigger move than what markets are priced in. So trust me when I say that if you buy a straddle and then the stock proceeds to move violently and much more than markets had expected, you're going to make money. Now, you might see the stock collapse. It might fall to 30, much bigger drop than expected. Well, your 36 strike puts are now worth $6. Your calls are worthless. Who cares? You paid $2.50 for the trade. You can sell it at $6. You made a killing, right? So that's what you're expecting. What about selling volatility? What are strategies that we teach that you can take through this? Well, there's a few of them. Iron condors are an example where you sell the 38s and you buy the 40s for protection, and you sell the 34s and you buy the 32s for protection. You're selling a credit spread below, you're selling a credit spread above. Why is that good? Because if the stock doesn't move much and these options are overpriced, then you're going to profit from the credit on both sides. You could just sell one or the other. You could just do the bear call, or you could just do the bull put. Those are other examples. If volatility drops and the stock moves less than expected, those are going to be good strategies. You could also do things like diagonals or calendars or things like that, where you sell one of these shorter term options that are really overpriced and buy one of the longer term that aren't as expensive. Let me take you through that point, because this is another factor around earnings that needs to be understood. So Microsoft is reporting earnings on Thursday of this week. Are all of the options in Microsoft priced the same? So are the July options, I'll write it out here, priced the same as August in terms of implied volatility? Okay, what do you think? Are they priced the same? We know what the average implied volatility was. If I remember right, Microsoft was at 22%. Well, that tells us what the average option is. But they're not priced the same. Okay, shorter term options are going to be elevated levels of implied volatility more so than longer term. And here's the basic philosophy behind that. If there's going to be a surprise around the earnings announcement, it can affect both of these options, of course. But the Julys, say they're a July weekly that expired this coming Friday, July 21st or whatever. Their whole life is based on this earnings report. Their value is pretty much going to be dictated purely on the results of this earnings report. Whereas the August options, they have a lot. They have this earnings report, they have any market moves, they have any, other stock announcements, et cetera, and just normal fluctuations of the stock. They have a lot that could happen. So the August options are going to be a lot more expensive, but they're also going to be less responsive to the announcement. They're not going to have the dramatic move that the July is, in all likelihood, if there was a surprise and the stock were to go completely nuts. And this is shown in the implied volatility because each option that you're buying or selling has its own specific implied volatility. Let me show you what I mean. If I pull up the options for Microsoft and we see that the implied volatility is at 22%, that means that basically the average option's trading at that. But let me make one thing very clear. The short-term, very, very short-term options are not going to be trading at the implied volatility. They're going to be trading much higher because this is their make or break moment. Do you see what these July 21st options are trading for? 47, 48, 49% implied volatilities. Why so high? Well, because that's all they're based on, is basically they're priced according to how this stock is going to move for the next 3 days. For the next 3 days, Microsoft is going to move different than it normally does, right? We already talked about that. Is Microsoft going to move its ATR? No, it's probably going to move more than that. So for the next 3 days, they're saying, look, Microsoft is normally that 45-year-old driver that has never been in a wreck. It normally moves like this. But you know what? For the next 3 days, it's going to be a teenager. It's going to move 48%, 49%, because it's going to have this big burst potentially just over the next 3 days. Now, there's no guarantee, but that's how the market's pricing it. It's saying it's going to be different for the next couple of days. But guess what? If you go out to August, it'll go back to normal. Let's go pull the August monthlies. They're 31 days, 1 month away to the August monthly expiration. And guess what? Your implied volatilities are back more towards normal. See, the stock price is trading at 72.76. So let's pull the at the monies. 72.50 calls 22.4. It's exactly what the average is. 72.50 puts 22.1. Basically exactly what the average is. If you go out to August, they're saying, you know what, by that amount of time, this will probably trade more normally. But for the next 3 days, all bets are off. For the next 3 days, this thing is like a teenager. It's kind of a make or break. Well, what does that mean for you as a trader? Potentially nothing, but from the standpoint of strategy, you have to make certain assessments for what your expectations are, bullish, bearish, neutral. You also do need to think about volatility. You need to think about how is this likely to move. Now, you can use some of its history. You can go back and say, well, how has Microsoft been moving on its most recent earnings reports? Has it, what am I likely to expect? You will over time get more familiar with many of these companies, what they typically do and how they typically move. But you are making an assessment when you put on a trade if you're doing it into earnings specifically. Now, some traders just say, you know what, I'm going to avoid earnings. I'm going to take all these kind of crazy equations out of the picture. I'm just going to trade its normal implied volatilities and be happy with that. If I were to make a trade in Microsoft, though, today, pre its earnings announcement, which comes out this Thursday, then I am trading implied volatility, whether I realize it or not. So I might say, this is all hypothetical, but I might say, and let's pull up a chart. Let's do a little more logical example here. I might look at this and say, you know what, Microsoft is in an upward trend. It's recently pushed to new highs. Do I trust this breakout? Now, what's it going to do from here? How do I think it's been moving? Well, kind of in this channeling pattern, now trying to break out. Do I trust it? If it fails, does it come back to about the midpoint of this base? You know, if it breaks out, how far does it go to the upside? What has it done in its prior earnings? Well, I'd rewind back 3 months. So here was probably the April announcement. And if I go back 3 months prior to that, here was probably January, somewhere in here. You know, so maybe actually it's probably that one. So, you know, I see it gapped up on its 2 most recent earnings announcements. Is it going to gap up here on its next one? You know, the Nasdaq has kind of struggled recently where it's not making new highs, but the S&P and the Dow are. Do I think there's something to that? You know, and I make an assessment for how I think the stock's going to trade. Bullish, bearish, or neutral. Let's hypothetically say that we kind of think it's going to sink in a little bit. It's going to maybe come back to the midpoint of the range, you know, for whatever reason. So I look at this and I say, okay, how could I take advantage of a drop in the stock, but also take advantage of these elevated levels of implied volatility? Well, I could structure something where I'm targeting 71. Right now the stock's trading at 73 or whatever. I'm targeting 71, so maybe I'll trade a diagonal. I'm going to sell implied volatility that's at about 48%. And what am I going to buy? Well, I'm going to buy an option. I'll maybe go out here to August monthly and buy an option that's trading at 22%. And if I'm right, and this stock goes down towards 71 or so, this is going to be a great strategy because the short-term puts expire, my long-term puts live on. I probably don't see a huge volatility crush in this one. It might drop from 22% to 19, 18, but it's probably not going to collapse. Whereas my July option that I sold with 3 days, it's going to collapse to 0. I'm collecting a 48% implied volatility, and you know, if it goes to 0, I make that income. Doesn't guarantee success, but if the stock kind of moves roughly how I expected, I'm going to have a good strategy. I'm going to have a good setup there. So one philosophy, again, in playing these earnings is to buy a reasonably priced option and try and sell one of those more expensive. You have to realize, though, the 3 factors are in play. Number 1, the stock's going to move more than normal, right? So expect some volatility in the shares. Number 2, we know implied volatility tends to elevate going into the announcement. A lot of traders even try to buy options a couple of weeks ahead and profit from that implied volatility increase. Number 3, implied volatility usually drops. Can even get crushed. So implied vol goes down after the earnings, tends to go up pre-earnings announcement. So those are some strategies and some things to be aware of. Now, good question. How do we figure out if the options market has it right, if it's priced right? The answer to that is there's no way to know ahead of time for certain, right? We can make educated assessments. And so I like to do things that give me an edge, even though I can't predict everything. I absolutely can't just look at a number and say, well, this is overpriced or underpriced. The reality is I look at it as the market is a lot of times like the Vegas books. They might set a line that you kind of are surprised by, but you know what? They get it right quite often. They're usually pretty good at setting these numbers. So it's pretty rare that you find something that's completely off. And it's actually counterintuitive, but I guess my most common scenario is when I see something that seems off, I often trade the opposite of what it seems. Now that sounds really crazy, but let me put it this way. If in Vegas the Patriots are playing against the Browns and they set the line at 7 points, Tom Brady and the Patriots playing against the lowly Cleveland Browns and 7 points. You and everyone else would say, holy cow, I've got to go rush and bet my life savings on the Patriots. They're going to kill the Browns and so forth. And I'm just telling you, if you ever see a number that seems off, you bet the opposite. Meaning, in that scenario, you'd say, you know what? They don't want to put it at 7. They don't want to put it at 7 because it's going to attract so much interest to the Patriots, which actually tells you that Vegas knows who's going to come flooding in, what side they're going to be on. They know they're going to get a lot of action on the Patriots at 7, which means they're even less of a favorite than that because the public's going to come push the line down to 6 or 5 or 4 where it probably should be. So Vegas is already kind of planning for that, and the line should be even closer. I mean, that sounds really strange, but essentially in the options market, it works the same way. If I come in and something seems really off, wow, that number is way too low, then guess what? It's even higher than it should be. They know the public's going to come in and think it's too low and buy it up, which means, it essentially it should be even worse. You bet on the opposite of your instinct that way. And it sounds crazy. I understand that. But it's been my experience that you take these things, and if you come in and you see that number is in your mind way too high, wow, that is way too high, it's probably not high enough. I'm telling you from experience, that's been the way. So that's a little tidbit that you'll have to play around with. You'll have to paper trade it. But it's been my experience again, time and time again, that whenever I see a number that seems off, it's actually off in the wrong way that I thought. And I've learned to be able to capitalize on that better because of that. So something to think about there. Yeah, buy low volatility, sell high volatility, but be wary of the extreme number that seems off. And let me give you, as a final point, let me wrap this up with something that makes perfect sense, I think, for explaining that. Look at the VIX. This is the average implied volatility in the market. It's down here at 10, and it's been down here forever. And everybody and their dog has been saying it's too low, it's too low. Trump's going to get impeached. Can you believe how bad it is? There's North Korea's got missiles. The market's at new all-time highs. It's so risky. It's going to collapse. There's all these reasons, and it feels incredibly low. It feels like the shoe's about to drop, and option prices are going to go skyrocketing, and markets are way underpricing what they should be. And guess what? The number seems way too low, and it hasn't been low enough. In essence, you've been rewarded for taking the quote unquote crazy trade, right? You sell volatility when it's down here at 10. Are you serious? And it keeps working and working and working, right? So I hope that's a good example. I know, it's in this market that seems really absurd when you find what you feel like is that crazy extreme. But usually, the flip side of that is when the volatility goes ramping higher and you start to feel like, oh, it's way too high, it's probably going a lot higher before it finally turns down. So it's pretty rare that your instincts, and let's just say that the entire marketplace's instincts are right. If it were that easy, where we could all just kind of say, well, now it's too low, we buy. Now it's too high, we sell. It doesn't really work that way. The way you feel about something is usually the opposite of how you should feel. When it's down in the dumps, we down here really low, we want to buy it. But you should keep selling that low volatility. When it starts ramping higher and people start saying, oh, it's too high, probably going a lot higher. So I hope that makes sense, but that's the way the markets operate. All right. In conclusion, let me remind you of a few different things here. Stocks move more than normal around earnings. We know that. So expect it, anticipate that. Implied volatility usually rises pre-earnings. I'm talking about the couple of weeks going ahead of earnings announcements. And then they usually decline post-earnings. So after the actual announcement comes out, there's usually that crush, and implied volatility kind of goes back to normal. Are there exceptions to both of those? Of course. When you trade earnings, you're making a prediction as to whether or not the current prices in terms of volatility are priced right or wrong. So make your assessments, put yourself in a situation where you have some outs, you have some opportunities to make money, whether the stock does exactly what you expected or not. If it goes sideways, does some things like that, those are good ways to make money where you don't need to be perfect in the trade. You just need for one of a couple of things to play out, and that's a good way to trade. So anyway, selling volatility versus buying. I gave a couple of examples. The examples I talked about were selling credit spreads, even diagonals and calendars where you're selling that really high priced volatility and buying the lower normal priced. Selling the 1 week and 2 week options and buying the 1 month, 1.5 month options, that sort of thing would be another example of selling overhyped, overpriced volatility. So can you buy and sell the VIX? You can. However, the VIX is an index option, and its options are based on futures. So the VIX is a different animal than most anything else you'll trade. Its expiration usually falls on a different date. So where most things expire on the third Friday of the month for a monthly option, the VIX can have an expiration on Tuesday. And also, don't do calendars and diagonals and things like that. If you're trading the VIX, trade verticals, trade single options, condors, butterflies, anything vertically where you're in the same month are fine. But when you get into diagonals and calendars, it's tricky because the July options are going to mirror or follow the July futures. The August options are going to follow the August futures. And in the VIX, those futures contracts are not identical. They're going to move different amounts. So it's not like a stock option where both are mirroring one single stock. That's not how the VIX works. The VIX options follow their futures contracts. So I just tell people, unless you really, really know what you're doing with the VIX, you just avoid trading anything across different months. Don't trade calendars and diagonals and things of that sort. So hope that's helpful. Thanks again, everyone. Hope you've enjoyed this class on implied volatility and using it through earnings. We'll see you next time. Goodbye, everyone.